So, my dear colleagues and friends, this is your instructor Tariq Darwish, and we are now going to take a look at project cost management. That is part of the big series of the PMP preparation course, and this is the chapter 7 on the PMBOK. So on this module, we are going to learn a few financial and accounting terms that are necessary for project managers to understand in order to differentiate between projects and select the more feasible ones. And you can expect that some exam questions on the PMP exam will tackle some or all of those financial terms that we are going to be talking about in this module. Then we are going to have the cost management processes, plan cost management, estimate cost, determine budget. We are going to learn in this module. Also on this module, we have this very important tool for cost control, the earned value analysis, earned value management, and earned value technique. You will have several questions on the exam that are related to earned value analysis. They are usually mathematical questions, and we will have some examples in the presentation as we go. Right. So, project cost management includes the processes required to ensure that the project is completed within the approved budget. So we will plan cost management, and we are going to estimate cost, we are going to determine the budget, and we are going to control cost. These are the 4 cost management processes that we will be dealing with in this chapter. And let's now start the chapter with the accounting terms I've been telling you about, and the first of which is opportunity cost. Now, in general, to understand opportunity cost, whenever you spend money, you are sacrificing an opportunity. So when you go buy commodity X, it means that you are sacrificing the opportunity of buying another commodity Y. So, for example, on a personal level, if you come to some money and you decide to buy the first red hot Ferrari that you will come across, because it was the sweetheart of your dreams at some day, and now that you have the money for it and you rush for it, that's nice and everything, but please consider that you are sacrificing the opportunity of, I don't know, maybe sending your kids to a better school or going on a nice vacation. So in business, that's also the same case. Whenever you decide to invest your money in a certain opportunity, you are sacrificing another. And every feasibility study or a business case should have a section talking about the opportunity cost. So what opportunities are we passing on if we decide to pursue a certain business venture, for example. Next, we have the so-called law of diminishing returns. As the name implies, returns will at some point diminish. So let's say a company has a new product and it invests in its marketing, advertising, and usually that results in increased sales and profitability up to a certain point. There will come a point in time at which or after which returns will diminish, and companies that have that score high on a business continuity index, for example, BCI, they usually forecast when this point will come, and they will be prepared with a new product or an upgrade of the current product. That's why we have iPhones 4, 5, 6, 7, 8, and so on. And similarly with Samsungs. And you can also see it in laptops and tablets and so on. There's always an upgrade or a replacement of an older product. Even with long-lasting products, they also undergo the law of diminishing returns, but the cycle might be longer, like food products, coffee, for example, or something, or products of that sort. So there is a cycle, and that cycle will happen to every product, except that for each product, the length of the cycle is different. And even in addictive products, like here I'm talking about legal addictions, like being addicted to some coffee brand or a certain soda brand. Even with those products, that companies cannot touch the taste because they are selling always the same Nescafe, let's say, or they're always selling the same Coca-Cola. Still, companies do some upgrade, but not to the taste maybe, but to the packaging. And I'm sure you have heard this slogan in advertising. They tell you, let's say Coca-Cola, the new shape and the same great taste. So they make sure that you understand that they haven't messed up anything up with the taste. They haven't touched that because the formula is always constant for that cola can, and what the taste that you expect to get, that your brain is programmed to like, it will not be touched. But they still need to make some upgrade. They have to refresh the product from time to time and do that upgrade, because otherwise the law of diminishing returns will cause the returns from that product to diminish. So what they change is the packaging, maybe. They produce a new size, but not the core taste. So that's the law of diminishing returns. You might have come across the term working capital. And working capital generally is defined as your total assets minus your total liabilities. That is your working capital. How much is your assets, tangible and intangible, are worth, and how much do you owe? Does the organization owe? Is your total liabilities. So the working capital is your total assets minus your total liabilities, and of course you want to keep that figure in positive territory. You don't want to have liabilities that are higher than your total assets. Next, there's the term depreciation, and PMI, as we have seen in some exam questions, they expect you to understand of course the term depreciation, and also the difference between linear and accelerated depreciation. So let's explain depreciation first. Depreciation, every asset that a company has undergoes depreciation. It loses some of its value over time. So for example, let's say your organization has a laptop that has been bought today, and the organization paid $1,000 for it. So that means that the organization has acquired an asset worth $1,000 today. A year later, we cannot book that same asset as worth $1,000. It undergoes depreciation. And there are accounting standards. I mean, it's not like every company depreciate at a rate that is invented by the company. There are accounting standards in various countries, and there are international accounting standards. So like, for example, for electronic equipment like laptops and office printers and copiers and so on, the depreciation is they are depreciated over 5 years. So if you have linear depreciation, let's say the $1,000 value today becomes $800 value a year later. So the same laptop, if you account for it, you account for it $1,000 as an asset. A year later, we account for it $800 as an asset, and so on. So that's the general meaning of depreciation. And of course, it influences the taxation, because before we tax a company on its profits, we have to deduct the amount of depreciation of the company assets before we calculate the tax. So let's say a company has made $10 million worth of profit. So before we tax that amount, we deduct from the $10 million the amount of asset depreciation of that company, among other things. But I'm just explaining to you that the role depreciation also plays in taxation. So so that's the concept of depreciation in general. There is the so-called linear depreciation. So it's like $1,000 asset, you deduct $200 for it each year. In 5 years, it's worth zero in book value. It's not like we are going to throw away that laptop in 5 years. We don't have to, but its book value is zero. So if two companies plan, let's say, a merger, or a company plans to acquire another company, and they are doing their due diligence, and they are appraising the assets of the company that is going to be acquired. So those assets that have been there for 5 years, electronic equipment, in the case I was talking about, their book value should be zero. So linear depreciation. Now there is also the term accelerated depreciation, where there is a percentage of depreciation on the asset year on year. So the first year, let's say the $1,000 laptop, if you depreciate it by 20% in 1 year, next year its value will be 800. Then if you depreciate it from 800 on 20% depreciation rate, so you don't deduct $200, you deduct 20% of the 800, which is $160. If you keep doing that in 5 years, the asset's worth, book value, it will not be zero. There will remain some residual value. It's also an accounting term, residual value in it. So it will never reach zero, but it will be a small value in 5 years. It's never zero. So some residual value will remain. Now, let's say you have an asset that is of zero value today, and still using it, and you decide to replace it and auction that old asset of yours. Now whatever money it brings in is called salvage value. So salvage value is regarded as some form of non-operational profit. So if you read financial reports and so on, you will see companies separating the operational profit from non-operational profit so that they don't mislead their shareholders. So maybe in some year they have a lot of profit, but a lot of it is not due to successful operation, but to things like selling old assets against a salvage value. So some accounting, some finance here. So project managers should be aware of such easy and simple terminology, what they mean, in order to talk to accounting and finance and understand the finances of their projects. Now, if you want to go deeper, you can take another course called Finance for Non-Financials, or Accounting for Non-Accountants, and you can take that further. But this is really what we think you need as far as PMP preparation course is concerned, and the reason we have put these particular terms here and explained them is that we have seen PMI addressing these terminologies in their PMP exam questions, and for a good reason. Remember, the PMBOK is a collection of best practices, or if you mean good practices, if you don't like the term best, good practices. And so it means that this is what most project managers most of the time might need under accounting and financial terminology. Now, the former accounting and financial terms were general finance and general accounting, Now, the following financial terms are especially related to projects. In projects, you might have fixed costs, and an example of that might be the setting up of the temporary installations for project management on the site. So that's a fixed cost, regardless whether the project is going to build 100 villas or 150 villas. You still need the same temporary installations to accommodate the project management team, for example. So that's an example of fixed costs. And here, project costs that remain constant regardless of phase or output. On the other hand, variable costs, these are the costs that are that change with the size of the project, for example, like cost of raw material, for example. If you build 100 villas in a housing complex or a housing compound, they will cost for steel. They will not cost the same as if building 150 villas. So that's a variable cost. Also in projects, you can have direct costs. These are costs that are clearly attributable to a certain project. So project X needs so many pipes. Project Y needs so many cables. So that's a direct cost clearly attributable to a specific project. On the other hand, there are costs that are not clearly attributable to a single project. So these are indirect costs. Like, for example, if you want to put some examples here, you might say the back office overheads in a contracting company. These are indirect costs that will be distributed over the projects that a contractor is executing. Finally, there's the so-called cost reserves, and these are amount of money needed above the estimate to reduce risk of overruns of project objectives to a level acceptable to the organization. So in simple English, this is a bucket, separate bucket, in which you keep a reserve to deal with project cost risks. So, for example, you're worried it might rain and ruin some of your work, let's say some of your excavation work. So you might have a reserve amount, a cost reserve, that if that happens, you will use that reserve in order to do some of the rework or pump the water out, etc., etc. That's the cost reserve. We will talk a little bit more about that when we come to the risk management chapter. Now, here are some more finance and accounting terms, but this time they rather relate to project selection methods. How do I decide if a project is feasible? So first of all, you need to account for things like inflation. So if let's say you are working on a business case and you are working on some cash flow projections. Now, money that will be, or that is expected to flow in or flow out in the future, you have to have a certain reference point. Let's say the present value. Today, you take today as a reference point, and all the money that will either be expected to be spent or earned in the future needs to be represented in today's value. You need to account for things like inflation. So if you expect to get $1 million in 1 year, $1 million in 1 year is not the same as $1 million today, because in a year there is the inflation to account for, whether it's positive inflation, like the vast majority of countries in the world, they have positive inflation of varying percentages. Very, very few exceptions. Some countries sometimes have negative inflation. And You need to account for that, whether it's positive or negative inflation. You have to account for it. And the general formula is that present value equals 1 divided by future value multiplied by 1 plus r and 1 plus r to the power of n. Now, r is the inflation rate, and n is the number of years, generally speaking. There's more detail to that. Some finance or financial departments and organizations, they will dictate a certain r, and they will call it a discount rate, regardless of the financial rate. So let's say an organization wants to make it very challenging to planners to show profitability for project prospects. So they kind of dictate finance departments, management, they dictate a certain high discount rate. Now, they tell you to discount at 30%, it means that they are making it challenging for you to show profitability. You will want to work on projects that earn fast, earn a lot, and earn fast, so that the amounts will not be greatly discounted, and you can show that the business case you're presenting is feasible. So the concept of present value, the value today of future cash flows, you need to take a reference point, usually today as a reference point, the present as a reference point, and all the expected cash flow, whether cash in or cash out, that you will feed into a business case, for example, has to be estimated in today's value. That's the concept of present value. Then we work out the net present value. So after working out the present value of each amount on a cash flow projections table, we add all the expected ins and subtract from it all the expected outs, the sum of the ins minus the sum of the outs, and that will give us the net present value. And of course, you want a positive net present value, a handsome net present value. Then there is the concept of internal rate of return. Now, if you had a chance to sit with a community of investors, for example, when they talk about an investment opportunity, one of the first things they try to work out or ask about is the expected IRR, internal rate of return. This is the, as the formula says, the determination of the discount rate at the point of net present value equals 0. When you have a net present value equals 0, it means that you have recovered all your investment. So they will ask, at the point when we recovered all our investments, so what is the rate at which we are recovering our investment? So to give you a simple example, if you expect, for example, to recover your investments in 4 years, let's say, that means that you have recovered on average 25% of your money annually. Okay, so that's putting it in very simple terms. And of course, the higher the IRR, the better, the more attractive the business opportunity is. Then there is the so-called payback period. So the payback period, as the name implies, this is the amount of time it will take to recover the investments. And of course, you want that to be as short as possible. You want to get your money back. If you invest $1 million in a business venture, you want to get that money back as fast as possible. And that's the payback period. Now, then we have the benefit to cost ratio. And again, as the name implies, this is the benefit on one side, the cost on the other side, and comparing them. And of course, in a benefits management plan, you might have financial and non-financial benefits. So if you want to work out a benefit to cost ratio, and this is a financial term, you've got to transfer all your benefits to a financial amount. So if you say one of the benefits of building a bridge, constructing a bridge downtown, is increasing the citizens' satisfaction with the municipality services, you cannot factor that into a benefits to cost ratio unless you attach a price tag to that. So you've got to find a way to transfer all your benefits, financial and non-financial, into financial benefits, and take all those benefits, compare them to the project cost, and work out the benefits to cost ratio. And it's a ratio, of course, and you want that ratio to be as high as possible. So 2 to 1, 3 to 1, 4 to 1, that's benefit to cost ratio, or maybe 1.5 to 1, or 1.1 to 1 benefit to cost ratio. You want your benefit to outweigh the cost, of course. Then we have the so-called sunk cost. Sunk cost. Sunk comes from sink, to go down. When a ship goes down, that's a ship sinking. So sunk cost, that's the cost that is lost and will never be recovered. Like, for example, the cost of R&D of a product that will never make it to market. In pharmaceutical companies, for example, many research projects will never amount to a marketable drug. And the money they spend on the research and development of unmarketable drugs are considered sunk costs. And it's a good idea that you don't factor in the sunk costs when you are deciding to go to market. So like we have seen in some cases, which something that is unethical, that some companies, because they have spent so much money on research and development, they still decide to market certain harmful products. And of course that is unethical and against the code of conduct of PMI. But I'm just trying to explain to you the concept of sunk cost. Well, usually eventually the consumer will bear that, and in the example of pharmaceutical companies, for example, when you buy a pill, you pay for the cost of manufacturing that pill, you pay for the cost of research and development for that pill, and also you pay for the cost of research and development of failed research projects. Of course, the money has to come from somewhere, and that somewhere is the consumer. And that is the concept of sunk cost. Yeah, opportunity costs. Yeah, sure. We already addressed that in a previous in a previous slide, so I'm not going to talk about it again here. Right. So here is a little exercise for you, colleagues. Which project would you select? One with net present value 95,000 versus one with present value 75,000. And if you recall, the higher the net present value, the better, because this is the sum of the expected earnings minus the sum of the expected spending. And of course, you want the earnings to be more than the spending by as much as possible. And if you are selecting one of two projects with these criteria, and this is the better choice. Now, which is a better choice? A project with internal rate of return of 13% or one of internal rate of return of 17%? And if you recall, we prefer the higher IRR, because the higher the IRR, the lower the payback period. Again, I'm just relating the two terms together, but in this exercise, it's like we're thinking about each KPI, key performance indicator, separately. Next, payback period. Do you want the 16-month payback period or the 21-month payback period? Of course, we want the payback period to be shorter, as short as possible. So 16 months is better than 21 months. Benefit to cost ratio, which is better, 2.79 or 1.3? Here we would rather prefer the higher benefit to cost ratio. The 2.79 is better than the 1.3. And so here is the solution, if you may. Right. So this is kind of a quick review on those financial terms and what they mean, and how they help you in selecting one project over another. Thank you, and stay tuned for the next bit on this cost management chapter.